We're looking at the markets and watching them boom. Countless days in the green. Conditions are worsening in the real economy, but who really gives a damn, right? Or we can objectively look at the data and analyze everything we have to make sure that what we are seeing is supporting our understanding of what's going on in the economy. It's really up to you. Ignorance is bliss, some would say. You came here for the truth, so let me unveil that for you. Today we're going to look at what Morgan Stanley has said. It's very important because they were right the last time around. If you remember this video that I recorded, it was filmed back in September of 2018, specifically stating the stock market will fall in December 2018 according to Morgan Stanley. Then I was completely ripped apart in this video in the comment section. If you look at it, thankfully they're all documented there because in September it looked like everything was rocketing higher. But what happened? Well, of course we saw December was the worst of the 3 months. October, November, December, things were looking terrible. In fact, by the end of December, just before it came back up, it was seeming as if this was it. Then we had the massive interventions from the central banks and so on, which changed things. Now I want to cover what they are currently saying. I'm going to go through their new model that they have. I'm going to look at all the details. We're going to talk about retail sales. We're going to talk about the economy, several economic factors today. This is going to be one of those old school money GPS videos. So let's get into it. Morgan Stanley said in a note on Monday that it now sees a 70% chance of the stock market in the US hitting a downturn within the next 12 months. Any slowdown in the US would most likely spill over into other global markets. Quote, "We now estimate that there is approximately a 70% likelihood that this will shift to downturn over the next 12 months. That is coming directly from Morgan Stanley. I am not saying that. I can't tell you that. I don't know what's going to happen in the future. But this is according to Morgan Stanley, the same group that told you the market would fall in December. Such turns do not necessarily mean a recession, but do correspond to materially worse return environments for credit and equities." This means basically it's not necessarily this is it, this is the bear market, this is the crash, but it does mean that we're in for a big change on the downside. Morgan Stanley told its clients to shift their investments from US stocks to the rest of the world, stocks in preparation for any potential slump. I'm going to talk more about that as well, what we've been seeing in the markets. In fact, we noted this ever since approximately September, October, that money is shifting. Investors are already making moves to prepare for a possible downturn. Flight to safety accelerated in March, with bonds and cash seeing further inflows while equity markets internals turn defensive. I have covered this all over the place in my channel. Barclays is talking about that in this article, but understand what's been happening ever since that time frame. It's not looking good. You can tell me it is, but the truth says otherwise. This is showing us their US cycle indicator probability of downturn over the next 12 months. We have not been at this point in the indicator since approximately looks like around 2007. They break it down further into exactly what it means. On the left-hand side, you have their old way of looking at it. On the new one on the right-hand side, it's basically different weightings for everything that they look at. But if you're interested, you can see all the details within it. What's important to note about this is that the new one is a way to look at things with less of a lag. That's basically what they wanted to determine, so that it's not, yes, this is happening, 5 years from now. That's not really valid. It helps, I guess, in some ways. When you look at, for example, a PE ratio, you could see that they're overvalued, but it doesn't necessarily tell you what's going to happen within the next year. You can just see that overvaluation. This, however, gives us a better look at things in a closer range. Morgan Stanley's US cycle indicator is sending two clear messages. A market peak is imminent and it's time to turn defensive. That's according to the firm's cross-asset strategists. So remember what they are saying here, that we're looking like we're at the end of the cycle. This is the peak, as well as it's time to take your portfolio and move it into more defensive positions. That means fixed income as well as stocks that aren't all about growth. That's not what I'm saying. Remember, that's Morgan Stanley. This indicator is a composite of economic and market trends, and it's on an unprecedented streak that points to losses for stocks and bonds. The firm's strategist provided 3 portfolio recommendations to guard against the possible downturn. It goes on to give you all the details there. That's not really what I get into on the channel. If you want to know exactly what they're saying about that, you can always look into the sources in the description and it will break it down for you. This article out of ING is talking about world trade. Looking past the volatile growth figures, the 3-month momentum shows a downtrend of 1.8% in the negative, indicating world trade is slowing. The prospects for 2019 remain concerning as what seems to be a cyclical downturn is dragging world trade growth down further. Pivotal to the slowdown is lagging Chinese growth, which is partly due to the US-China trade issues that undermine US demand for Chinese exports. So of course the whole world is waiting for these two countries to resolve their issues. I don't know if that's going to happen anytime soon. We have seen this getting pushed back further and further. It's like the Brexit issue. It's seemingly never ending. As soon as you open up the news, there's constantly something about these two issues never ever getting resolved. Out of CNBC, the Fed solidified its U-turn on March 20th, hoping to get off the stage, not to be in the spotlight, but instead we've got issues on either side. On one hand, you got the White House pressing for a 50 basis point cut. Not only do they say cut, but they specify how much you should cut. On the other hand, you have the Fed officials saying not only are we unlikely to cut this year, but hikes aren't off the table, and you don't want that to develop. There's a lot at stake, obviously, and we have to see what happens with the Federal Reserve. I'm not sure they're going to be increasing anymore. As far as I'm concerned, they're probably going to have to leave it where it is. If they bring it up anymore, the market is simply not going to take it. Surging labor costs and slower revenue growth likely will lead to a drop this year in corporate profits in the US and other developed economies. Industries that could see their bottom line hurt the most are those that rely heavily on blue-collar workers. With so many people attaining a conventional higher education, companies are having a harder time finding blue-collar workers than white-collar workers. This stark imbalance has helped boost the paychecks of blue-collar workers. Many people have talked about this. This has been an issue now for a while. Individuals, they're going to, let's say, post-secondary education, university and such, and this has gotten them a degree but not necessarily a job, whereas people who go the route of, let's call them the blue collar as they're doing here, they're finding jobs that are well paying and they will be more secure when a time in which they are entering a recession. If there's a skill, if a person has a skill, they're more likely to keep their job. According to Goldman Sachs, earnings outlook is getting grimmer by the day, so hide out in companies with big margins. So this is all part of that shifting of the portfolios. I've been talking about it for months on here, and it has been the case that investors are doing this, and I've been documenting the process throughout. Headed into the first quarter reporting season, investors are bracing for the first earnings decline for the S&P 500 firms in more than 2 years. In such a slowdown, investors should focus on companies with high and stable gross margins, also known as high pricing power. From the beginning of December through the end of February, minimum volatility stocks have performed the best and value stocks also outperformed, while small caps and momentum stocks performed the worst and quality also slightly underperformed. This pattern matches what has occurred in the contraction phase of the economy on 4 of the 5 factors. Essentially what this article is talking about here is that there's a time and a place for each of these different types of stocks. You don't necessarily just buy and hold for long periods of time, and this is not something that most people should be doing. They should be adjusting their portfolio. Now that doesn't mean that you had, let's just say, Netflix stock and then you sell 100% of the Netflix stock. No, it means that you start to work that portfolio a bit, you start to get smart with it, but that's none of my business what people do. Apple slashes iPhone prices in China. You might have heard about this. This had to come down. Several factors along with this. Number one being the sales are down terribly. Weak February U.S. retail sales underscore slowing economy. We heard about this back in October, November, December, and they use this as one reason or another. It's the weather, it's the sky that's blue, it's the moon that came up, it's a full moon, it's a half moon, it's a crescent, and so on. Well, it doesn't really matter because we continue to see this happening. Take a look at this. Core retail sales month over month in the negative. Looking at the retail sales year over year as well. And then you can see retail sales, building materials percentage change, that's in the negative also. But when I say this, don't worry, because now nearly 5 million homeowners can now save money on their mortgages. So you can see the 30-year fixed mortgage coming close to 4%. That means about 5 million people are going to refinance their property and they're going to save money on their mortgage. That can extend the boom even further. I know many people are going to do this, and it only delays the inevitable. This is the big problem that a lot of people aren't aware of. They'll say, well, the Fed will keep this going until 2020. I don't need to worry. But if they keep pushing it further and further and further, that just expands the bubble, and it's going to get messier. It's going to get dirtier, and you are going to be in the crossfire. And I hope that people smarten up. That's all I'm trying to say. If you found this video informative, please give me a thumbs up and give me a like on this video. You are supporting me. You are supporting the truth, and I do appreciate that very much. If you want the financial education that was not taught to you in school, these 2 books have everything that you need, from the foundation, the 4 asset classes, all the details, top to bottom. You can get that at the link in the description. If you want the audiobook, that's available at themoneygps.com. Steve Eisman called The Next Big Short. If you haven't watched this video already, I've been talking about it a lot, but you should definitely check it out. Click on the video and I will see you there.